Are you able to beat the market and get higher returns? This is one of the most important questions to consider when you start investing. Why? The appeal of active investing is that a financial expert with deep market knowledge could theoretically outperform the market by picking undervalued stocks or predicting downturns. And the hope is that they can avoid major losses in your portfolio by stepping out before a massive crash will hit the stock market. But here's the challenge: can anyone really do this consistently?
And we also tried hire quantitative manager, John Gorniak by name, to run Vanguard quantitative portfolios. And it seems so easy. There's the S&P 500. Just get rid of the 5 worst stocks or the 3 worst stocks, and all of a sudden you'll do well. Seems easy. It wasn't easy. And he barely outperformed the S&P 500 after taxes. I think maybe underperformed with that quantitative portfolio. And I honestly can't remember if we still have a quantitative portfolio or not. But it didn't work.
So, like Jack Bogle said, most investors, even professionals, find it extremely difficult to beat the market over the long term. So let's take a look to an important data studies have shown. Here you see the stats from active managers who are able to outperform the S&P 500. And what's really interesting to see is that in the first year in yellow, there are around 50% of the managers that beat the market. But if we subtract this data to 20 years, you can easily see that on average, actively managed funds often underperform broad market indices like the S&P 500 over a longer period of time, especially after fees are taken into account. So on average, after 20 years, you can see that less than 10% is able to outperform the market. So more than 90% of actively managed funds are underperforming over a period of 20 years. So the key risk with active investing isn't just that you might fail to outperform the market, but that you could also miss out on significant gains while attempting to time the market. So throughout my career as a financial advisor, I have heard many asset managers reassure clients that they will reduce the risk when the markets get bumpy. And that's exactly what you as an investor want to hear, right? The promise of avoiding downturns seems like an ideal solution, especially when you are nearing retirement. But here is the reality. Can they really do it? And here is what Jack Bogle's findings are about this approach.
What about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock pickers market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock pickers market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one.
So the question is, if you have an active fund manager who is able to consistently outperform the market over a longer period, is there even a possibility that they can reduce the risk for an investor? And one of the best examples of investors who have managed to outperform the market over the long term is Berkshire Hathaway, led by the famous investors Warren Buffett and Charlie Munger. And I think what's really interesting to see is that throughout their careers, Warren and Charlie have experienced market downturns over 50% on more than 3 occasions.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in?
This is the 3rd time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets, that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.
Despite their impressive track record, they also had to navigate through the deepest bear markets just like any other investor. So timing the market is generally not a good idea. It can cost you a lot of money if you get it wrong, right? But there's another risk that many investors don't fully consider when they are looking into this topic. And I have a short story to explain it. So when I just started out in the financial industry, there was a special room with a trader's desk, and it looked impressive. Big screens everywhere, graphs on the walls, and portfolio managers on the phone intensely discussing the economy. And it felt like I was in the heart of the action, where decisions were being made that could make or break an investment portfolio. And this is exactly the kind of risk Jack Bogle warns about in this video.
Let me say a word about managers with skill, which Gus mentioned. Yes, there are some managers with skill, and sometimes they beat the market. But if you think of Vanguard in one way, and people don't talk about this, competitors, we don't even talk about it. You are investing for a lifetime. And find me a manager that has beaten the market for 75 years or 50 years. They don't live that long. Start with that. That's an important qualification. And they turn over. The manager's typical fund lasts eight years. Half of the funds, I mentioned this the other day, yesterday, half of the funds go out of business every 10 years. Where is this genius who comes in the business just the day you come in, manages your money until your retirement, and then you both retire happily together and rich? They don't exist. And by the way, if that's the time sequence, how do you know to go to them? They don't have a record yet. So this industry is complicated, things that to me are very, very simple.
So Jack Bogle's belief was straightforward. Stay invested, ride out the volatility, and trust the market to deliver long-term gains by following a broad index fund like the S&P 500. Yes, there will always be some investors who outperform the market. However, the critical question is, do you want to bet your money on this possibility when the data shows there is a 90% chance they won't consistently achieve it? And you might be thinking, but Maurice, it's easy for you to say because you have a lot of experience. What about someone just starting out? And that's a great question, and I'm glad you asked. For those new to investing, simplicity is the key. In this video, we will discuss a straightforward yet powerful 3 ETF portfolio, and it's designed to be easy to understand and implement even if you're just beginning your investing journey. This approach provides a solid foundation for great returns.